Well, in a manner of speaking, in the last 3 months, if not more, there has not been a bank that has probably created more wealth and created more buzz than Yes Bank. And it's a privilege of sorts that on our 7th anniversary, we have the man who's brought smiles to, well, scores of investors who are investors in the bank, and get his view on the bank, on the economy, on the banking system at large. Rana Kapoor with us. Thank you so much, Mr. Kapoor, for joining in today.
Real pleasure to be with you.
Great, thank you. So, let me jump straight to the point. A lot of talk about how the banking system currently is placed and the kind of moves that the Reserve Bank is taking as well in order to help the system, in order to rectify a lot of problems, predominantly with the PSU space, but banking system by and large. What are your thoughts here? I mean, the debt recast plans that have just announced as well.
In my assessment, Reserve Bank of India has been working on a very concerted plan to make sure that there is a soft landing for the economy. By that, what I mean is that we've got a fair amount of corporate, leverage. We got number of, stalled and choked projects, and Reserve Bank of India's interest in a fiduciary capacity has to ensure that with the banking sector that we create systems and norms that have a resilience and be able to bank also some of the projects that were stuck. So I think in totality, in my judgment, in my assessment, these are like welcome moves. They are good moves. They build a system for the future, and overall, let's face it, there has been a lot of de-risking, a lot of debulking. A lot of the promoters are working towards ensuring financial closures. So in totality, the response to this level of deregulation by Reserve Bank of India and some very proactive measures is reasonably positive.
You think that is happening as well? I mean, corporates by and large, which were stressed, fully stressed or half stressed as the case may be, are actually going out and trying to, revive projects, because I hear banker after banker come on air and tell me that companies within the power space, companies within the commodity space, steel, etc., are all now starting to show the signs of revival. They are all coming up to the table and talking about reviving the projects. Are you seeing that as well?
Yeah, very much indeed. I think what is happening is that the overall economic backdrop, aided by macroeconomic improvements that have happened, and these are very significant improvements, right? We got a fantastic backdrop of overall harnessing of inflation. We got excellent reserve position. We got a situation where the overall current account deficit issue is no longer like a big challenge. The fiscal discipline is intact, and I think the overall evangelism of the country, the brand equity of the country, is really resonating worldwide. So to come to the main point, I have all reason to believe that the de-risking and the debulking of balance sheets, corporate balance sheets, which have had high leverage, and I think there has been a very opportune moment through whatever circumstances that have been created for large corporates to actually rationalize their business models. Right. So the super conglomerate model is getting a little consolidated, and there is a need for divesting some businesses which have been low earning and other businesses that are going to be like critical or mission critical for the future. So that kind of deleveraging of corporate balance sheets through mergers and acquisitions is a very good sign. India is a buy versus build market for domestic and foreign investors, which is a very good sign. And I think the second component, which is very, very important as well, that the stalled projects and the choke projects, whether they were in roads, in power, and a couple of related sectors, they have been literally, prioritized by the government, by the bureaucrats, and by the bankers in terms of achieving financial closure. And I think the success in roads, particularly, somewhat in the thermal power sector, is remarkable. So the de-risking has to happen on public sector balance sheets, accompanied by corporate deleveraging and by some of these stalled projects moving forward. So I think now it's in tandem, and it's only a matter of time.
You think so? In a nutshell, would you go as far out and say that over the course of the next 24 months, and I'm not talking about a Yes Bank right now, you wear as an industry captain's hat, that asset quality by and large for banks, be it privates or PSUs, is on the mend, and corporates themselves which were stressed will actually go out and make the job easier?
I think for the industry, let's say to aggregate, is turn the corner.
Okay.
And I think the messaging that is coming from leaders in public sector banks like Madam Bhattacharya, which is a very powerful signal that almost all the recognition has happened. I think substantially the provisioning is under control. The third step is, remedial actions. And I think the other factor related is that promoters are also realizing that they need to galvanize and they need to also de-risk their business models.
Sure.
So the centripetal and centrifugal forces, I use this analogy in the bank, seem to be working towards a magnetic field to repair the past. And I think the overall conducive messaging that is coming from the government and the overall, direction of macroeconomic creates an environment for banks to reap the benefits maybe 4 quarters later. By 2017 March, I think substantially the overhang of past problems should subside and we should look at a lot of fresh growth in the system.
Okay, you gave me the answer that I was wanting. Thank you so much for that. Now, my question is this: I'm not saying that it's a battle between the PSUs and the privates, but quite frankly, from a market's perspective, 12 months ago, the talk was, for example, Aditya Puri saying that he will go out and fund infrastructure projects as well, something that they have probably not done in a big way. So there was a bit of a talk that how private banks will take away share of businesses which are hitherto the turf of only the PSUs, SME credit, infra projects, so on and so forth. Do you think with the signs of stress easing for the PSUs as well, also because of the RBI measures, that movement will not be as pronounced as what was believed earlier?
You see, I'll tell you very frankly, the issue is not, let's say the housekeeping in the public sector banks. I think the health of the public sector banks is mission critical for the Indian economy. It's their health helps to create, let's say, to get the wheels of the economy moving, because credit is probably one of the most important lubricant for getting the economic momentum going. So I feel very happy to see that public sector banks, with whatever repair has happened, give or take 4 or 6 quarters, they should be back into the system. I don't think it's like a whole lot of market share that private sector banks are going to steal from the public sector banks. I think the opportunity is for private sector banks to partake in the new growth, which is very, very lucid, very, very evident. And I think the foreign bank compression to me is probably the more attractive opportunity in the market right now, because a lot of the foreign banks for reasons to do with global strategies, home country strategies, global compliance, global regulatory environment, are in a state of compression. So there is a lot of good market share for private sector banks, including our bank. And I think the public sector and private banks have a very good partnership model that they do a lot of lending, we do lending, plus we do also a lot of the other related cash management, treasury, trade finance, payroll banking. So we are a very complementary model. And I personally believe that the systemic risk which today exists in the Indian banking sector will subdue with the restoration of the public sector banks coming back into motion.
Okay. And I'll scratch this point further, but I just have one more sectoral question to you before we get to a couple of specifics on yes as well. Somehow the commentary in the last RBI policy led people like me to believe, at least, that from an earlier stance of relatively aggressive rate cuts for the country, you'll probably have one, at best two, for the remainder of FY17. We are no longer in the aggressive rate cut cycle that we believe we were in earlier. Is that a disappointment? And I'm not saying it's RBI is doing. They are probably doing what is best. But is that a disappointment?
No, if I have to take a step away to answer this question, that the fact of the matter is that you heard yesterday the Federal Reserve, board governor, speak. The fact is the global economy is still in the doldrums, right? The fact is that there is sluggishness, in the world's number one economy. There is slowdown in the world's number two economy. There's barely any pickup in Japan and Europe, right? So in my judgment, the global forces remain, subdued. Number two, in India, the only thing that bothers us excessively in my assessment is the CPI movement of, food prices, which is very seasonal. It's somewhat to do with import and distribution policies, and it should not bother us to see 15, 20 basis points of shift in the CPI. The fact is that India needs a lower interest rate regime to get growth going, to get the impulses of industrial production, manufacturing somewhat more catalyzed going. To me, is absolutely at a stage where it becomes very pivotal to restore rest of the economy. I think the services economy is doing better. Hopefully, if the Met forecast becomes reality with the right landfall after a very good rainfall forecast, to me means that at least there is a little impetus in the rural economy, and the government is paying a lot of attention to the rural economy. And I think the overall manufacturing sector in some parts is doing very well. So in a sense that today the economy is well geared, I have every reason to believe that a lower interest rate regime, which India needs to get its growth back, inflation is under control. We get too distracted by a few basis points here and there, can be harnessed. And the third factor, which is very, very pivotal, which RBI has done a superb job, is to make sure that there is abundant liquidity in the system and none of the banks are hampered from any form of incremental lending. So a lot of, let us say, stars are lining together for a very good second half in our economy. And I think the next 2.5, 3 years should be fantastic performance. I won't be surprised if we exceed 8% this year of GDP growth and nudge towards 9% by 2020.
Touch wood, inshallah, as they say. But so still, just getting back to my question, so you think headline repo 25, 50 or more for FY17?
See, judgmentally, I believe it should not be, our economy should not be more than 5% repo.
Wow, okay. Even if that were not to happen, with the liquidity measures that you are saying, do you think deposit and lending rates come off 50, 75, 100 bips in FY17 itself?
You see, it's already happening. I think the fact of the matter is, please remember, we complain about not enough transmission, right? The fact is, this bank rate, MCLR are all very good, transparent developments. But please remember, there is an extraordinary cost, which nobody, talks about in a sense of interest rate movements, which is like the provisioning cost. So banks have to deal with the provisioning cost, and therefore, once this provisioning cost load goes away from, whatever larger public and private sector banks, to me, that is going to alleviate and move towards transmission to lower rates. That will happen. But this is a, right now very awkward situation where a lot of provisioning is still to be made in some banks. And I'm quite happy to share with you that in this backdrop, the overall confidence in Indian banking after the measures taken over the last 3-4 quarters has really gone up. I've been meeting investors in the US, in Europe, and also in Asia. I must confess that people are saying at least the banking system in India is being repaired super fast.
Wow. So you're meeting investors. Are we to presume that the proposed fundraising is just around the corner?
No, Yes Bank has been ready for fundraising for a while.
Yes.
But we have reason to believe that there are certain triggers in the system. We like to believe a bank like ours is a growth story.
Yes.
We've done respectably well on preservation of asset quality. We have demonstrated steady growth. Our overall, granular growth of liabilities is pretty on the spot.
Yes.
And the diversity of our loan portfolio driven by more accretive SME growth, retail growth, and lower risk corporate growth augurs very, very well for a capital raise because we have to invest in growth.
Yes.
So we are in a state of preparedness. that within this fiscal year, and still like 9 months to go, that we will raise, our target is to raise $1 billion.
Yes.
And in our life cycle, it will be a very important event, because then we become a small, large bank to partake in India's growth story.
You're again being modest, Mr. Kapoor, but you know, this was anticipated. I mean, your tier 1 10.7, everybody believes, and I believe you yourself internally would have.
Overall cap at is at 16 and a half.
Yeah. No, and anyways, the growth targets internally also, I believe, would be northwards of 2025 for the next 4 or 5 years. So you'll probably need this capital as well, and it's probably not even ROE dilutive. But my question is this: so if indeed you raise this capital, and I have no doubts that you'll be easily be able to do it. You reckon that for Yes Bank, for the next not just 3 years, but arguably for the next 5 years, a superior growth rate northwards of 20, or possibly 25, at a stretch maybe even a 30, is a distinct possibility?
I think we have entered a life cycle, let's say inflection point. Some people call it a sweet spot. It's happened to one other bellwether stock in the country. And when they were like our size, or rather we were their size, so we hit that sweet spot. And the beauty is that we got now critical size, critical momentum in our retail, in our SME businesses.
Yes.
And we are a proven bank in being fairly supportive and fairly resilient on asset quality, even vis-a-vis corporate businesses, mid, large and small. So I think with this equation established with a demonstrated track record, Yes Bank is probably one of the finest growth stories in Indian banking right now. Our brand is doing well. Our frugal innovation is doing well.
Yes.
Our HR is resonating in terms of quality of people, quality of leadership, top, junior. Average age of the bank is 31 years. And then we are building more and more refreshed technologies, service technologies, which are of a bank which is considered to be an innovator, not only in India, but actually in the world today, as a bank which is driven by quality and by innovation and at a frugal cost, so that we can serve even our inclusive requirements in our country. So I think there are a lot of propellers, a lot of turbo engines in the bank, which augur well for a good growth cycle. And we should grow 27 to 30%. The management team is convinced, the board is convinced, and we should do even better in some parts over the next 5 years.
That's a telling statement. And you forgot hard-working team, because I can vouch the leader is indeed working very, very hard. But I still...
Our mantra is very simple in Yes Bank. Very simple. Harder you work, the luckier you get. And that applies to Yes Bankers, it applies to our shareholders.
Okay, great. Okay, but shareholders don't have to work hard if indeed you are doing this.
They're working hard on investing in the right place at the right time.
That they are, but they would want to know whether this fundraising would happen latter half of FY17 or immediately. When do you reckon?
There are certain global event risks which I think should be out of the way very soon. There is the Met forecast, which is a very significant trigger in our system. There's a credit policy which is going to be also very, very critical, I think early August. So there are some material events. We have to observe all these events. We have to do another 1 or 2 quarters to show how good our asset quality is, how good our earnings trajectory is, how sustained our growth is, and how well are we consummating our growth model. Because Yes Bank is now a small, large bank in India. So to me, the track record of every quarter continues to be very important. The management team is really very driven and proven and still very young. So I think when you see all these, this constellation of all our factors, the capital raise is a matter of time, and we will do it, maybe by 31st of March 2017 or sooner.
I'm sure it'll be sooner. Nevertheless, my final question though, Mr. Kapoor, is that, and I wrote this down, you have a great ROA and the things that people expect you to do. I'm just trying to figure out how much more will you do in the next 5 years, because everybody says you will do all the retail assets, credit cards, personal loans, auto, home loans, and you will also do in-house broking, mutual funds, wealth management. Do all of these things now start coming in sooner over the next 3 years, or do you think that will come with a bit of a lag?
You see, the product suite of the bank is almost complete.
Yes.
Short of launching credit cards, which is less than 30 days away,
Okay.
we are like absolutely fully complete on product platforms, driven by new age technologies, frugal technologies, efficient technologies, and with transparency in technology, they give you good MIS systems. The brand is resonating, right? So my point is that, and with great leadership led by Pralay Mandal, my senior colleague, that we think that the propellers for SME banking, retail banking, and most of all retail liabilities, because we still have to drive our CASA to 40% and beyond, that is extremely visible today. We thought it will take us till 2020 to get to north of 40%. The management is convinced we'll get to the target well ahead. Last year we grew CASA by 5% in 1 year. So even if we do like 4% a year, next 4 years, we should be like well past 40%.
Right.
Our net interest margins are really steadily improving with CASA accretion, with lower cost liabilities, with better composition of more attractive assets, SME and retail. So what I'm saying is that the model in its diversity, in its granularity, in the full spread of the model, corporate, retail and SME is now into its like fullest being. And 2 years from now, 2018 latest, we have reason to believe that our SME engines, our retail engines will be about 45% of our business, up from about 35% right now. And that makes our bank extremely comprehensive in terms of liabilities and the granularity of retail and consumer, which also means that with new growth in the economy, there's a lot of interesting opportunities which are coming up in renewable energy, in transportation, logistics, healthcare, life sciences, food and agribusiness. A bank like ours is gaining market share. We are targeting to get to 3% market share by 2020. But the other thing which I think is swinging in our favor is actually the mind share in our focus sectors. In our focus sectors, and there are about 14, 15 of them which are fairly pronounced, in those sectors we are resonating, we are capturing mind share, market share, and our risk management tactics are helping us. Our product platforms and the re-platforming of the bank is helping us. And our relationship people are very charged because they've seen difficult times, and therefore the ability, once you solve problems, you become better decision makers. You become better grasping abilities improve. And therefore the touch points with clients improves. And I think the brand is also connecting very, very well. And I'm very confident that the next 4-5 years should be like a very, very significant phase of growth with some tailwinds. Naturally, we need all that,
Wow, and you're sounding very passionate as well. Thank you so much, Mr. Kapoor, for joining in today and giving us your thoughts. Especially important having you on our anniversary day.
It's been a very delightful exchange with you, and on your 7th anniversary, lucky 7, I'm sure, and your channel continues to rank as #1. All I can say is the quality of your channel, the overall substance, the content, the application, the meaningful, let's say, knowledge you accrete on a daily basis through your channel helps businesses, all kinds, not only corporate businesses, banks. I'm sure it helps small, medium enterprises, the youth in India, which is looking at absorbing knowledge. I would give absolutely A+ on your 7th anniversary to what I believe is a very stimulating and very motivating channel.
Thank you so much for those kind words. Really good of you to take the time outside today.
Thank you.
Find us on Facebook at facebook.com/etnow and don't forget to click the like button. You can also follow us on Twitter at etnowlive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/etnow.